It's no secret that history repeats itself. And when it comes to the stock market, investors will twist themselves into knots to convince themselves that this time, it's different. In fact, legendary investor Sir John Templeton, who delivered an average of 15% annual returns over 38 years, called those 4 words the most expensive in the English language. And he was right. Nothing drains a brokerage account faster than blind optimism masquerading as financial genius. That brings us to Jesse Livermore. A pioneer of speculative trading, Livermore inspired the main character in the best-selling book Reminiscences of a Stock Operator. He's best remembered for building fortunes by shorting the market during crashes. He once said, "There's nothing new on Wall Street. There can't be, because speculation is as old as the hills. Whatever happens in the stock market today has happened before and will happen again." And right now, there's a stock market bubble that hardly anyone talks about anymore. A bubble that looks disturbingly similar to today's market. I'm not referring to the dot-com bubble of the early 2000s, or the 2008 financial crisis. I'm talking about a bubble you probably haven't heard of. One that, when it burst, caused devastating damage. The market crashed 50%. Many of the world's largest companies lost 60 to 80% of their value. Inflation soared from 3% to 11%, and the market didn't fully recover for 8 long years. I'm talking about the Nifty 50 bubble of the early 1970s.
The story begins in the late 1960s. America had just come off a 20-year economic high following World War II. Factories were humming, suburbs were springing up everywhere, and Americans felt invincible. People had money, they had confidence, and above all, they had blind optimism. Why wouldn't they? The US had defeated Germany in World War II, put a man on the moon, allegedly, and most importantly, invented the Etch-A sketch. Life was good. At the center of this optimism was the stock market. From the end of World War II in 1945 through 1970, US stocks had surged more than 350%. This extraordinary bull run gave rise to a new investing strategy, one-decision stocks. The idea was simple: buy companies so powerful and dominant that you'd only ever make one decision: buy. These became known as the Nifty 50, blue-chip giants with stable cash flows. Names like Coca-Cola, American Express, McDonald's, household brands everyone trusted. Investors viewed them as bulletproof. The thought of ever selling one, pure madness. Here's the truth about investing. If something sounds like a no-brainer with zero downside, it's almost always a financial grenade with the pin already pulled. And that's exactly what happened. By the early 1970s, the Nifty 50 weren't just expensive. They were priced as if gravity didn't apply on Wall Street. The overall market's average P/E ratio was a reasonable 15, respectable, normal. But the never-sell frenzy drove Nifty 50 valuations into fairy tale territory. Coca-Cola traded at 46 times earnings, Xerox at 49, McDonald's at 86, Polaroid at 90, and the list went on. On average, the Nifty 50 traded at a staggering 42 times earnings. It didn't stop there. At the peak, the top 5 Nifty 50 stocks accounted for about a quarter of the entire market. The full group, roughly 45% of the total US stock market. Then came 1973 to 1974. The dominoes toppled, one after another. Oil prices quadrupled. Inflation spiked above 11%. Unemployment doubled from 4.5% to 9%. And President Nixon effectively ended the gold standard for good. The stock market plunged 50%, the worst bear market since the Great Depression. When the economy crumbles, overpriced stocks don't just correct, they get obliterated. In the Nifty 50, Coca-Cola fell over 60%, McDonald's dropped more than 70%, and Polaroid, it collapsed over 90%. The so-called one-decision stocks became one giant financial disaster. And the real pain, it wasn't quick. No sharp V-shaped recovery like after the pandemic. It took 8 years until 1981 for the market to claw back to its pre-bubble highs. Investors who thought they'd bought eternal growth were stuck in financial purgatory for nearly a decade. Now, if today's market gives you a slight sense of déjà vu, you're not alone. Mark Twain said it best: history does not repeat itself, but it does rhyme. And while not identical, today's market undeniably rhymes with 1972. Back then, the Nifty 50 made up nearly 45% of the US stock market. Every dollar in an index fund was a bet that those companies would grow into their sky-high valuations. Fast forward to today, the plot is the same, just with better special effects. The tech giants, known as the Magnificent Seven, now represent about 36% of the entire S&P 500. 7 companies, Microsoft, Apple, Google, Amazon, Meta, Tesla, and Nvidia, carrying the weight of the whole market. If that level of concentration feels familiar, it's because it is. Yes, the Magnificent Seven are innovative. Yes, they dominate their industries. But so did Xerox. So did Polaroid. So did Avon Products in 1972. The Magnificent Seven have become the modern version of those one-decision stocks. And when it comes to valuations, they're priced as if gravity still doesn't apply. Google and Meta trade at 28 times earnings, Amazon at 35, Apple at 37, Microsoft at 38, Nvidia at 50, and Tesla at 247 times earnings. Are they great companies? Absolutely. Are they overpriced, overweighted, and treated as bulletproof? Also, yes. Just like in 1972, investors are telling themselves the same story. These companies are untouchable and will grow forever. All we're missing is a few macroeconomic dominoes to fall. Warren Buffett put it perfectly. What we learned from history is that people don't learn from history. So here we are again, staring at a top-heavy market, pretending valuations don't matter, and whispering the 4 most expensive words in the English language. This time, it's different.